as Mitch and Joe just mentioned, we just dropped this new report. It's titled "The Structure of Cyclical Markets." It was written by me and Will, and of course, Mitch and Joe were huge in getting that out. But essentially, this report goes over. It starts by examining the macroeconomic short-term debt cycle. So that's kind of the cycle that drives a lot of the borrowing and spending behavior from you know American citizens and market participants in general, and that's driven by monetary policy from the Fed. And then we also examine how that overlying cycle determines the cycles for individual financial assets. So we look at gold, we look at fixed income securities. So we look at treasury bonds, high yield corporate debt. We look at treasury inflation protected securities, and then we look at the stock market as well. And then from there, we kind of pivot to Bitcoin, and we start looking at, what are some of those similarities and differences between Bitcoin cycles. So, how does it relate to, the equity markets or those traditional financial assets in the short-term debt cycle, but also, how is Bitcoin unique in the ways that we can, examine the cycles and see what drives price cycles in Bitcoin. It's fairly long. It's 28 pages. So if you're looking for some, reading over the weekend, I highly recommend checking it out. I think it's super useful information and can help, you no matter, what type of, investment product you like to invest in, Bitcoin, fixed income, whatever. I think there's something there for everyone, and it's a super educational piece. So, be sure to check that out. We have it pinned, my tweet about it pinned up at the top there if you want to go look at it. But pivoting to the newsletter, so I want to start off obviously we had another big week for the stock market, right, following last week's 75 basis point Fed fund rate hike. But one thing that really grabbed my attention this week was this continuation of announcements from big companies that they're laying off employees. Almost a week ago, we got a new data point for initial jobless claims. So if you don't know or don't remember, initial jobless claims measures the amount of people that are filing claims for unemployment or unemployment benefits for the first time following job loss. So it's essentially looking at unemployment levels. And initial jobless claims rose to 260,000 last week, which is just 1,000 less than the year-to-date highs that we saw just a few weeks ago. And this came alongside news from Amazon and Walmart this week that they've begun laying off employees. So for Amazon, it was 100,000 layoffs. For Walmart, it was hundreds of corporate employees. And I actually discussed Amazon and Walmart in the newsletter 3 weeks ago. And what I said is that we need to be on the lookout for layoffs from them specifically as a signal of a potentially deteriorating job market. And the reason for that is that Amazon and Walmart are two of the largest employers in the U.S. Walmart's the number one employer. Amazon is, I want to say, in the top four. And so these are, obviously large publicly traded companies that employ thousands of people in the United States. So they have the ability to cause drastic changes to the unemployment landscape. But today we saw the release of the July jobs report, which showed this massive increase of 528,000 jobs for the month of July. And I found this super interesting because obviously that's a pretty bullish report, but what we just talked about is potentially showing signs of this deteriorating job market. Despite those large layoffs, the job market appears pretty resilient. And I wrote about this in the newsletter last week, so I'm not going to go over it again in detail. Go read last week's newsletter if you haven't already. But there's certainly reasons to believe that the job market is weakening or softening despite this July jobs report. Moving on, in this newsletter, I also shared a chart from Goldman Sachs, which shows or compares GDP to a survey of CEO confidence. So what we've seen in the last four recessions, except for 2020, we saw CEO confidence vastly lower than declines in GDP. And today is no different, as this chart shows, which is interesting to me because the Institute for Supply Management, or ISM, released a new data point this week for their services PMI. So this is looking at, it's essentially a survey of purchasing managers in the services industry. So it's just showing sentiment. And what we saw is actually an uptick in sentiment for purchasing managers in the services industry. And this was something like I can't remember, I want to say like the 26th month in a row of increasing sentiment. which is super interesting. Despite all the macro uncertainty and debate, are we in a recession or not? Purchasing managers in the service industry are more bullish than ever. Um, so I so this difference between the sentiment between service PMs and CEOs is interesting. I honestly don't really know what to make of it, or what's causing that difference in sentiment, but I think it's interesting. So I included it in the newsletter. So then, pivoting on Thursday, or I'm sorry, on Tuesday, we heard from the president of the San Francisco Fed, Mary Daly, which you might have seen on Twitter because her quotes were everywhere. And that's just because she was significantly more hawkish than Chairman Powell was last week. And in my opinion, that's clearly an attempt to walk back some of that dovish tone that Powell took last week. So she was saying things like, the job on inflation is far from finished. I anticipate a slower economy. I anticipate a cooled off labor market. Just all these, sort of hawkish things that inject fear into the markets. So, as we've discussed in this newsletter before, I've wrote about it maybe 2 or 3 times now, but when the markets rip after a Fed funds rate hike, it undermines that goal of the Fed to lower inflation. So now, as there's talks of, are we near a point where they're going to start decreasing the rate hikes, and we're beginning to round the corner on rate hikes, arguably, what they don't want to see is financial asset appreciation, because that puts money back in the hands of investors, and it allows demand to pick back up, which is not something that they're ready for quite yet. So Daly injected some fear into the bond market, and on Tuesday, we saw yields jump. In today, they're continuing that jump with 10-year yields are up about 16 basis points at the moment, which is pretty massive. I think it's also possible that the bond market doesn't like the jobs data, which is kind of interesting and maybe not the way a lot of people would be thinking about it. But bullish jobs data could indicate that that aggregate demand is still strong, right? Companies have remotely higher earnings than people were expecting, so they're not laying off employees like people would expect them to at this point of the cycle. So what that would mean is that the Fed may have to continue to raise rates longer than what the bond market was initially expecting, which is one potential explanation for what's going on today. But honestly, nobody knows. I don't have the crystal ball. I just think that's something that could potentially make sense. But rising bond yields place sell pressure on equities because it compresses valuations, which I've explained a bunch of times in the newsletter, and I wrote a little bit more about it in the newsletter today. So check that out. But that's coming alongside this super extended stock market. So currently the S&P, or I should say, when I wrote the newsletter yesterday, the S&P sits around 4% above its 21-day EMA, and it's about 6% over its 50-day SMA, which historically is a very extended range for the S&P to be in. So generally, we see buyers become exhausted and sellers kind of take the reins once the S&P is about 3% over its 21-day and 5% over its 50-day. So what I wrote in the newsletter is that I'm personally anticipating a pullback in equities here, which we could be beginning to see today. But what has been great to see this week in the stock market is the expansion of breadth. So market breadth refers to the number of names that are participating in a given market move. So one way to think about breadth is that it's the foundation that the market stands on. So when you have wide breadth, or a lot of names participating in a rally, there's strong support for the indexes, and there's less individual points of weakness. But narrow breadth would indicate that only those mega cap names are holding up the index. And generally, in this year, what we've seen is that market advances are led by pretty much only those large capitalization names like your Amazon, Apple, Tesla, whatever. But recently, in the last week or two, we've seen breadth expanding. So more and more names are beginning to participate in the rally. And I measured this by looking at the McClellan oscillator, which is one of my favorite breadth indicators. And the McClellan oscillator is essentially a MACD of the advanced decline line. And if you don't know what that means, I explained it in the newsletter. So, once again, be sure to go check that out. But these large cap names and also a lot of the smaller ones are also super extended and definitely due for a pullback. So, be on the lookout for that. Also, real quick, I just think everyone should note that July's CPI value will be released on Wednesday. So, definitely be wary and keep that in mind. Obviously, it's going to be a highly volatile day. But that's kind of the broad overview of what I talked about. obviously there's a lot more in the newsletter, and I go a lot more in depth. So be sure to go check that out.
Thank you, Blake. So what are you expecting personally from the CPI announcement? Do you think it's going to be higher or lower than what June was?
Personally, I would probably expect a higher value. And kind of the reason for that, obviously, you have all this supply side inflationary pressures right now. But you also have to keep in mind that CPI is a backwards looking metric. So really what you want to look at is what happened a year ago, to try to determine what could potentially be happening with today's CPI value. So what we saw about a year ago is that oil prices were stagnant or falling, which means that margin between last year's prices and this year's prices were generally higher, and the energy and food portion of CPI is the most volatile portion of that metric. So I think looking at energy prices, obviously there's more than just oil, but oil's the big one. Is super important to understanding what CPI could do. So personally, I'm expecting a higher value. I don't know off the top of my head what the analyst consensus is. But once again, it's one of those things like nobody knows what's going to happen. Obviously, the market will price something in. But I guess we'll see.
Something else on the jobs report you mentioned, I just pulled it up, and it's talking about 500,000 jobs added or whatever. But it's, at least this article is really highlighting the fact that nominal wages are up about 5 to 6%, but it's ignoring the fact that in real terms wages are down. So I think that adds to your hypothesis that like the jobs market is in worse condition than it may seem on the surface.
Yeah, for sure. And that's one of those things I mentioned earlier in my rant, that I talked about this stuff last week about how there's some signals potentially that the job market's weakening. And real wages is one of those. So we've seen real wages declining for the last 2 years. So it kind of almost does the job that unemployment does. So when you have, in real terms, Americans are growing poorer because we're seeing this increase in spending, we're seeing a decrease in savings, and we're seeing a decrease in real wages. So in real terms, in aggregate, Americans are growing poorer, which is sort of the job that unemployment does, is because you want to take money out of the hands of Americans in order to lower spending. And of course, that's what higher interest rates do as well. So, I think it's, definitely interesting. And that's something that I mentioned last week in the newsletter as well. So if you guys want to read a little bit more about that, and I provided some other metrics as well that are similar and show that relationship in last week's newsletter. So check that out.
I think that's also like the decrease in spending. It becomes really valuable when you talk about looking at Amazon and Walmart laying off workers, because if those companies are doing bad, then I feel like that's a pretty good indicator that Americans are not spending money, because like most people, if they're doing well, they're going to spend money at those two companies.
Yeah, for sure. It's pretty interesting because what the data is showing us right now, looking at consumer spending, is that consumer spending is rising, which is not exactly what the Fed is aiming to do. But the reason for that is because you're in this super inflationary environment. So you have all these inelastic goods that you have to buy to stay alive, right? You have to pay for your energy, you have to pay for your food, whatever. So what happens is the price of goods is rising, and all that does is just increases spending because you have to pay for more expensive goods. So that kind of goes with the decrease in savings that I included in last week's newsletter. We looked at the savings rate, which is the amount of money of disposable income that Americans are taking in, that they're saving, and that's just falling off a cliff basically. So what you're seeing is that Americans are just essentially draining their bank accounts in order to stay afloat in an inflationary environment.
And I kind of want to twist that to a point you made in your research report, which everybody in the audience, if you're just now getting in, Blake and Will released a report this morning on market cyclicality. You're definitely going to want to check that out. But one thing it talks about is during high inflationary or high recessionary periods, like gold doing well. And obviously we understand that Bitcoin is better than gold. So would you, if we're in like a period of stagflation, how would you see Bitcoin performing over the next 2 to 3 years?
Yeah, I mean, what it comes down to, and we talk about this in the Bitcoin section of the report that we've just released, it comes down to institutional preferences, right? So, Bitcoiners might think that, Bitcoin's digital gold, but institutional investors who make up, anywhere from 70 to 90% of the capital in the markets clearly don't believe that. And they throw Bitcoin into that risk asset cohort of, financial product markets. So, while the idea of Bitcoin, or, the benefits of Bitcoin may put it into that gold category with that, high stock to flow ratio, or it doesn't necessarily matter because institutional investors don't believe it. Or maybe they just don't really fully understand it. But as long as Bitcoin is put into that risk asset category, it's likely not going to perform like gold does in a recession. And I think, I'm a Bitcoiner. I think, down the line, many years in the future, it could become that. And it becomes this debasement hedge. And it still is, but the market generally isn't recognizing that. So, personally, I wouldn't expect to see Bitcoin begin to perform like gold does during recessionary periods. But, of course, anything's possible. But it's just all about that, institutional preferences and institutional sentiment on Bitcoin, which at the moment doesn't appear like it's changing.
Well, perhaps with the, obviously I'm no Blackrock fan, but maybe the tides could be shifting here with their announcement recently, or they could just be speculating. I guess only time will tell.
Yeah, no, that stuff's super interesting. And I forgot to mention it here, but I talk about it in the newsletter. So, I write the general market update, and then I write a section on crypto exposed equities. So this week I talked about the Coinbase Blackrock deal, and then I talked a little bit about the MicroStrategy earnings and Michael Saylor moving to executive chairman. But I think it's the BlackRock deal is super bullish for Bitcoin, and that's BlackRock is the largest asset manager in the United States. They have something like $10 trillion dollars in assets under management. So, the fact that they're now pivoting to allowing crypto services for their customer base is, I think, super bullish for the asset. And it's definitely like something interesting to keep an eye on is, like I mentioned, all this, the institutional sentiment towards Bitcoin. So that's obviously, the sentiment moving more bullish from institutional investors, especially from BlackRock, the largest asset manager in the United States. So it's definitely something to keep an eye on. Super cool. I wrote a little bit about it in the newsletter too. So check that out.
Yeah, it's very fascinating. There's just all these like little clues of institutional adoption going on, and people, I don't know, normies seem to be ignoring it. We had MicroStrategy and then Tesla, and they sold some of it, whatever. But they got Grayscale Bitcoin and now BlackRock. Like institutions are getting into it, even if people aren't paying attention to it. So I guess with that, we'll shift over to mining. Joe, do you have any comments on macro before you start talking about mining?
Yeah, I think you guys made some pretty fantastic points. I do have one thing on macro before I transition to mining real quick. I thought it was interesting how the 528,000 jobs number kind of or obviously conflicts with key names laying off workers or stopping hires that we've seen over the past few weeks. But it kind of is a sign that the labor market from an unemployment percentage perspective is kind of still strong. So I'm curious to get Blake or Mitch, both of y'all's thoughts. Like, is it possible, maybe not this month, but in the coming months for this year, that inflation, maybe starts to drop, but the labor market doesn't drastically ever deteriorate from an unemployment percentage perspective? Instead, people are taking the real wage cuts. Maybe that's going to be the blow in the labor market instead of a massive spike in unemployment.
Yeah, I think it's certainly possible. Obviously, who the hell knows? It's also possible that 2020 and 2021 were some of the largest earnings years for a lot of these companies. So a lot of companies have tons of cash sitting on the side, so they're able to eat those higher interest payments that have come alongside rising CPI. Right, the Fed raises interest rates, and so that the goal of that is to take cash out of the hands of businesses and individuals. But it's possible that, due to the earnings environment that we saw the last couple of years, that they're going to be able to eat those higher interest payments for a longer period of time. So, generally speaking, they might be able to retain more employees than they generally would in previous recessionary periods. Obviously, like I said, I don't know what's going to happen. Nobody knows what's going to happen, but that's certainly a possibility. I talked about in the newsletter this week and last week that there are some signals that parts of the job market or the consumer is hurting. But overall, right, you look at the job market data for July and it says that everything's fine. So it's certainly possible that the job market never really breaks down the way that a lot of analysts are expecting it to.
Yeah, I mean, I think it's safe to say that like when you go through the pandemic that we had and the massive monetary and physical stimulus that we had, that any recession or economic output after that is going to be not a normal recession, right? Like we're kind of living through, like, I hate saying the word, but unprecedented times, and there's not really necessarily much history that matches exactly what we're seeing.
Yeah, definitely. It's sort of this combination between the 40s and the 70s. So the 1940s was the last period, and I talk a lot about this in the new report. So once again, you got to check that out. But in the 40s was similar because it was this period of extremely high debt. So you had this, massive budget deficit following the Second World War. You had public debt levels that were extremely high. And the difference between the 40s and today is that following World War II, you had this, post-war boom, right? You had productivity rising, you had population rising, you just had economic output expanding like drastically. But due to diminishing marginal returns, it makes it super hard to do that today. So the economy is already extremely efficient. So raising GDP to match debt levels is extremely hard to do, and arguably impossible. And then you have that piece from the 1970s where you have extremely high inflation. So it's remotely similar to the 70s in that you have this stagflationary period, but it's closer to the 40s in that you have extremely high debt levels, which we didn't have in the 70s or 80s. So I think it's super interesting for sure. Yeah, like you said, I mean, don't like to say the word either, but it's definitely, unprecedented times.
Yeah, makes a lot of sense. Cool. I can transition it to mining real quick and we can wrap that up. Again, for mining and the newsletter and in this space, been talking a lot about the miner capitulation that's been going on. And the metric that I use to monitor this is hash ribbons. And it's a metric created by Charles Edwards from Capriel Investments. And miner capitulations, for those that don't know already, they basically occur when a significant net percentage of miners turn off machines over an extended period of time. So this current miner capitulation began on June 7th of this year, and it has lasted, a significant amount of time. And I think it's when looking at these miner capitulations, it's important to note that they're particularly relevant because they reveal that a large number of machines are simply no longer hashing. So since June 7th, other new generation machines have actually likely been plugged in by both public and private mining companies. However, I think, there's enough old generation machines or inefficient, over leveraged miners that actually have shut off. And that's why hash rate and difficulty have actually decreased. In the newsletter, you can see a chart of Bitcoin's hash ribbon metric, and you can see this visualized pretty clearly. But with that said, with hash rate dropping, difficulty did rise this week. And I think if there are no new lows in Bitcoin, which, it's very dependent on U.S. equities and macro, then I think if there are no new lows, we should expect this miner capitulation, according to the hash ribbon metric, to end in August or September at the latest. And in fact, like earlier this week, mining difficulty actually went up about 1.7%. So it's possible that was the bottom for mining difficulty, but time will tell. I thought in the newsletter that it would be interesting to compare this miner capitulation to the miner capitulation that we had back in 2018 when the price of Bitcoin fell from 6,000 to 3,000 and ended up marking that bear market bottom. That miner capitulation actually lasted about 73 days. And it was obviously very accurate at identifying a price bottom for Bitcoin. And so if the current minor capitulation also lasts 73 days, that would put the end of this capitulation at August 19th of this year. And so, I guess there are no guarantees that this capitulation will be the same, of course, but it is kind of reasonable to expect that this capitulation will end before October, like I said, as long as the price of Bitcoin just doesn't fall, sharply much further. Second thing I want to quickly cover is news that Riot came out. Previously, Bloomberg has covered how Bitcoin miners are adding resiliency and strength to energy grids by acting as these demand response entities that will turn off when the grid is strained. And so Riot is basically contracted in Texas to curtail its operations when demand for energy is high and supply of energy is tight. And so this contract basically allows them to sell capacity back into the grid instead of mining Bitcoin. And this is exactly what occurred during the month of July. So Riot's machines only had about 79% uptime during the month of July, but they actually earned more money while their machines were down because of this demand response program. And so Jason Less, who's CEO of Riot, he had an interesting quote in the press release. I'll read it. Basically said, when applied to, and he's talking about the power credits that they received for shutting off their machines. He said, when applied to anticipated power costs for the month, the power credits and other benefits are expected to effectively eliminate Riot's power costs for July, further enhancing the company's industry-leading financial strength amid a challenging macroeconomic environment for the industry. And so I think it's kind of interesting that Jason pointed out that effectively this demand response program enabled Riot to mine Bitcoin for free during the entire month of July. And during like these troubling times for many Bitcoin miners, it's nice to basically have margins that are practically 100%. But it was an interesting point covered in the mining space this week, and it'll be interesting to see how the minor capitulation continues or ends sometime soon.
That's super cool.
Definitely, and I think it reminds me of your energy gravity model, right? So if the minor capitulation is over, it means more miners are coming online. The hash rate and difficulty are going to go up, which means the cost of production is going to go up. And based on that, the relationship between the price and the cost of production, like Bitcoin's price should start to take off. And when you couple that with other on-chain metrics like the moving average and realized price, like, I mean, we're no fortune tellers, but it could be the bottom for Bitcoin, and we've seen historically Bitcoin as the leading indicator. So just something to look out for.
Yeah, exactly. I mean, minor capitulations historically have been pretty interesting and great at marking Bitcoin bottoms, because while they're occurring, you have all of these weak miners getting purged from the network. Like, they're selling pretty much all of the Bitcoin they mine, and some of them are purging their Bitcoin treasuries if they've borrowed too much money near the top, and they're actually having to sell more Bitcoin than they mine. Because they were trying to hold all the Bitcoin they mine near the top. They may even be selling mining rigs as well. Some are defaulting on loans that they took. Some took out credit against Bitcoin that they held in their treasury. So there's definitely, during these capitulation events, there's a lot of forced selling from miners. But after the capitulation event, when the weak miners have, one, sold all their rigs, and two, sold all their Bitcoin, difficulty is lower. And the only miners that remain on the network are those that were stronger, obviously, than the weaker miners. And so now on a day-to-day basis, you have less sell pressure from the remaining miners on the network, and you've purged all of those weak miners that were just selling as much Bitcoin as they could just to survive.
Bitcoin punishes the greedy, because a lot of the capitulated miners took out a lot of leverage. And then it's the same for the people trying to trade Bitcoin with leverage. So, like, the best thing you can do in Bitcoin is just survive. That's the best way to get through these bear markets.
For sure. Also, I know I've mentioned it like 100 times now, but we talk a lot about what Joe was just mentioning in that new report. So, if you're looking to learn more, obviously read the newsletter, of course, but that our new report will also touch on that a bit. Excuse me.
Yep. So we got the newsletter coming out later this afternoon, and Blake's fire report this morning. So a lot of high quality content coming out from the Blockware team today. You guys got any more comments before we wrap up here?
No, none for me. Definitely check out the report that is already on the Blockware Solutions website, and yeah, subscribe to the newsletter if you want. It's totally free. Check it out.
Oh, and Joe here interviewed Darius Dale for the Blockware podcast, so that should be coming out this weekend. Keep an eye out for that on our YouTube channel.
100%. Go check out the newsletter. Mitch, is this going to be recorded on YouTube or anything?
Yes, this is recorded, and it should be up on YouTube this weekend or early next week. This is
cool.
A pretty good conversation, so if you came in late, don't worry. We got the whole thing going up, and it also records on Twitter, so as soon as it's over, you can play it here on Twitter. So I guess with that, we'll wrap up. Hope everybody has a great weekend. Make sure to check out all our content, newsletter, report, YouTube, etc. So we'll see you guys next week.
Yeah, thanks for listening, guys. Have a good weekend.
Thanks, guys.